The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, folks, good morning. And we're going to start out the show. I'm going to put a chart up here from the Elliott Wave folks. It does a really good job of showing this pattern that we've been looking at for well over a year now. That's that 5-wave, the expansion, that expanding triangle pattern that is completed. He shows the low from 74 to 2009 and the relationship between 2009 and here as being 0.618. There's a lot of other things that are there too, but that's the main one that he happens to be focusing on. What I'd like to spend a little bit of time about today is what's really, in my opinion, what's happening. Where everyone's looking at the stock market, that's what gets all the news and everything. But folks, that's not what the real problem is. The real problem, in my opinion, is threefold. And I don't believe stocks have anything to do with it. They're a byproduct of it, but I don't think they have anything to do with it. These are not in order of importance because I don't know what the importance of these are. But the first is debt. We have not had a rate increase from the Federal Reserve in 9 years. We've had quantitative easing now for 6 years, which was a great experiment. This allowed people to borrow money that were not able to borrow money, and probably a lot of them weren't even able to pay it back. But that has really inflected the normal business cycle of 4.5 years. It's been around forever, and that's what, part of the problem, that I see occurring. This has caused this increased volatility that we've had in the stocks this past week. I don't know if you folks track this or not, but last week the Dow Jones moved 10,000 points, folks. 10,000 points. That's 10 times more than the whole range of the 1950s, 60s, and 70s. And that is the real, that's what stocks are doing. But the real problem is in the debt market. And the debt market is bothered by, and stocks too, but it's bothered by the second thing that I want to talk about. First was debt, and the second one is the derivatives market. The derivative market is supposedly somewhere between what was it? Well, actually, it's 1 quadrillion to 1.5 quadrillion. A quadrillion is 1 million trillion. So you could, I don't even know how many zeros that would be, but with all these derivatives, many of those things like credit default swaps and CDOs and all these other things that we don't even know that are out there are really non-regulated. And this is the part of the problem that was brought about when President Clinton took away the Glass-Steagall Act, which was brought out in 1935 or 1936 to prevent commercial banks from going into investment banking. And so this allowed the J.P. Morgans, the Bank of Americas, the Wells Fargos, and the Swiss banks, and all the others to go into investment banking and do what they're doing now. And you know what happened in 2009 and between 2008 and 2009. This time, this is going to be even worse here, folks, because we don't have the liquidity to take care of this. We saw this when the market dropped on the 24th of August. It dropped 1,100 points. I remember for many months here, I've been saying that we would see a day easy of 500 points down in the Dow, and we did that, and then we saw another one, 1.618 of that, which was 1,100, and we'll see another one, 1.618 of that, which will be 1,800. And that's just in the normal confines of a correction in the market. I heard a gentleman today say, we could have a nice 20% correction here in the market, and that would be a good thing, and it probably will be a good thing. But you just have to be really be alert here, because the volatility is increasing very, very fast, and it's going to probably increase even more. Try to protect yourself, the best way you can. Now, the third thing, the first one was debt. The second one was the derivatives of what's going on in the derivatives market. And remember Warren Buffett, he said that derivatives were the weapons of mass destruction. When I started trading, back in 59, we didn't have the NASDAQ. We didn't have an options market. Now we've got options on options on options on futures on options. I mean, we've got everything. We've got these ETFs that I don't think anybody really understands, and there's so many people in them. What happened if there's no counterparty risk on these things? That's the other part of the derivatives market that you don't understand, is what can be the counterparty risk, like what happened with long-term capital, that they can't fulfill their obligations. So we are really in deep doo-doo, as near as I can tell. Now, the third thing I wanted to talk about, that we all know what's going on, and that is deflation. We've been dropping for a year and a half now in everything: silver, gold, copper, aluminum, tin, rubber, chemicals, crude oil, heating oil, gasoline. Everything has been going down. And this is a sign of a massive deflation. This is what the Federal Reserve is, most fearful of, and there's nothing they can do about it because it's just a normal market factor. I believe it's brought on by the fact that China probably expanded or overproduced somewhat. I don't know. It's very hard to get good information, and accurate information out of China, so you have to rely on the charts. I don't trade that market, but I listen to what's happening to it, and so I'm not sure what's going on. All I know is that we are in an area where watching these charts is very important, and it's not the stock market is not the problem. It's going to be one of the things that gets tagged along and hurt, but the real problem is in the debt and the derivatives market. I'm afraid that one of these mornings we're going to wake up and we might have a situation where someone is unable to perform on another side of a counterparty risk, someone that could be long something and cannot deliver, or short something and cannot deliver, and that's going to bring an outlier event into the market where people change their thinking on economic thought. So that's what I think is going on. Now, today's an anniversary date of such. This was the date that Princess Di passed away. I remember this day very vividly because it was a big stock market day. We had a really big Mercury cycle at that time called Combust, and the market had a huge move that day. Frankly, I don't remember whether it was up or down, given the fact that what we've been going through over these past since the 24th, it's been basically a 24-hour market with swings like that. We're seeing when a market can move 10,000 Dow points in a week, that is such an outlier event, and yet nobody even brought it to anyone's attention. I was shocked when I listened to the news over the weekend. I listened to some of the investment shows over the weekend, and they talked about the volatility, but they never talked about how much the Dow was moving. They moved 10,000 points. That's 10 times more than all the decade of the 1950s, 60s, and 70s, and most of the 80s, because we didn't start up in the stock market until August of August was the bottom. August 9th of 82 was the bottom, and then in 83 we finally, it was 85, we finally took out the highs from 1974, as I recall. But wait and see what happens. Okay, now we're going to take a look at some of these charts that I've prepared for us for today, because I think they're interesting, if nothing else. We had a situation where we had a whole lot of these patterns we know as the ABCD patterns. The first one that I want to put up here is the New York Stock Exchange Index pattern. And as you can see, from the 24th, when we had the big reversal, we completed an ABCD pattern. We went into the gap so that the market actually closed up on the week, still down quite a bit from the high, and that was a 50% retracement of the whole move that we made from May the 9th. So that was an interesting one that was there. The next one that we want to take a look at, I'm going to do these not necessarily in importance, but just to let you know that they're all doing the same thing, which is a good thing if you're watching these things, because it tells us, that this is what we're looking at here with the market. Boy, the market sure comes back fast when it comes back, doesn't it, folks? Anyway, this was another ABCD market. An ABCD pattern in the NASDAQ that also occurred on Friday. And as you remember, Friday was the full moon. and the perigee, and it was a absolutely spectacular thing. And one of the questions that we've had from our dinners is what does it really mean? And I'm going to take a second here just to show you what this happens to be here. You'll see here, this comes from the one from 2000 and August the 10th of 2014, but it's the same thing. It'll show you the difference between apogee and perigee, and you'll see how it pulls the moon apart. Those of you that were outside last night taking a look at this super full moon, you'll realize it was just spectacular. It was 30% brighter than normal, and that's where it gets the idea of it's also called the harvest moon later on in September and October. It's also called the sturgeon moon because the sturgeons in the Lake Michigan area react very highly to this astronomical event. But it's nothing more than the apogee and perigee. Perigee, you can see the Earth is close to the moon, and apogee is when it's far away from the moon. Pythagoras knew this in 600 BC, folks. He knew the Earth was round. He knew the distance to the Earth. He understood apogee and perigee. I mean, this guy was so far advanced that it was really, really quite amazing. So this is what apogee and perigee is. You can Google some of this if you want more information on it. So it's really something really quite neat to look at. Now, if we take a look at the Dow Jones E-mini, we're going to take a look at it's doing exactly the same thing. We have every pattern, all of them doing exactly the same thing. That's very unusual, and you can see that we on the 4-hour chart we made a 61% retracement of the high on August the 17th, and that was the key cycle date. And now we've broken down, and if this is correct, we should, if we close badly today, if we close down more than 400 or 500 points in the Dow either today or tomorrow, this would most probably set up a very large A, B, C, D pattern, taking us down. We'll see, we dropped on the first move. We went from 1750 to 1530, so we dropped 2,500 points. So we would drop another 2,500 points from where we are right now, and that would take us down somewhere around the 14,000 area in the Dow, and the S&P number would be right around the 1550 level in the S&P if that were to happen. Now, I believe that will be, the first major leg down in the crash. And I do believe we're in a crash scenario now because of all the things that are happening in the world, and of those three things that I mentioned: debt, deflation, and derivatives. And this is the way it looks like. The volatility is increasing. The market is telegraphing you that get the hell out if you can't take the risk. It's telling you that right now. And that's the way it looks to me. Whether I'm right or wrong, we'll wait and see. All right, boys and girls, we'll be back soon, and then we'll have the opening.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we'll get back to the stock market here, but I posted into the Tiger TV so you can take a look at these 10 stocks that are basically control the NASDAQ 100. Those are the really big ones that move the market quite a bit. I believe that's about 35% of the whole 100 index, giving the weighting that you have there of Apple, Google, Gilead, and all the rest of them. But this is a factor that just a few stocks can make the market look a lot different than it really is. If we go one step further here and take a look at the breadth of the overall NASDAQ, you'll be able to see this is the NASDAQ 100. It shows the, I get this from John Murphy, it shows the advanced decline line, how it's been going down. We've been talking about that for quite some time, the fact that the breadth of the market has been so bad. You can see we've broken way below the March lows, which is a very negative thing. We mentioned many times once we went below the March 13th lows that we would be in a prolonged bear market. How long it's going to last, I'm not sure. But we've had a market that broke really badly on the 24th, and then it rallied the 24th, 25th, 26th, 27th, 28th, the 5 days, right into the super full moon. And so if that's correct, this is all we're going to get is a 5-day rally in a bear market, and then we'll see if it starts to go down. However, if we turn around today, and believe me, there's a lot of people that want to buy stocks, if we turn around today and close above 2,000 in the S&P, that will certainly tell me that this cycle that I have is certainly wrong, and I'll have to look at something else. But longer term, I just don't understand how anybody could be bullish stocks here. Looking at everything that's going on, I mean, it's just it's really deteriorating badly. It's acting badly, and even when they get good news, it's not helpful. To see what's going on. We have several things on a longer term basis that are very important, and that is the fact that the weekly charts have also turned down. We've had a situation where we've gone below the lows of the previous swings for the first time in the last 9 years. And the last times we've done that, you can see here that we've had tremendous. And this is the worst break that we've had on any of these years. If you look at those three drives to a top that we had, 2000, 2007, and 2015, all of which were perfectly equal in time. This is the first big break that we had, and what's not the first? Well, it's the first big break in 2 years, but we did it so vehemently. We've gone about twice as fast down than we have before, which is a sign that it wants to start to see even greater momentum here. So that's another factor that's important. The other thing that we have is the Bradley model is telling us that we are looking for a low sometime here in late September, early October. And one other factor, seasonal factor that has been in the market for many years, and that is that September and October are the two most ominous months of the month for down moves. In other words, they usually make bottoms in September and October. In 1929, the market made a high on September the 3rd of 1929, and then it broke 33% down to it broke 40%, as I recall. It went from 383 to 180, so it broke about 50%. It did 50% to the downside. On November the 29th is where it bottomed in 1929. And then from 1929, it rallied into April of 1930. It rallied almost 61% back, about 59.6% back. And from there, it dropped 90% in value into July the 5th of 1932, when the Dow made its final bottom at 42, I believe. And from there, we went to 18,000 and change, and possibly even more. So these are some of the things that are on the negative side. But remember, these markets are very volatile, and because of those 10 stocks that are in the NASDAQ and a few others, you're certainly going to be able to get lots of opportunity here to see what's going on. We're going to be opening here, and that's always going to be crazy time, because the market was up 600 one day, 300 and some the next day. So we rallied 1,000 points in 2 days. So even the shorts are probably going to be looking at something very, very interesting here if the thing is moving that way. When we come back after the break, I want to talk a little bit more about the gold and silver and also crude oil, because it's all related, to the deflation, that we have going on. But we got a pretty clear picture now in gold of what we could do here if it sets up the way that I'm hoping anyway. And hope is one of the worst trading things that you can have. So we'll take a little break here. Market's opening. We'll be right back after these few words.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization memorization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's nadex.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on Tiger TV at TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, so we're going to take a look at a market that is going to take a look here at what's going on in the overall market for metals, and that is the gold market. Last week I was talking about trying to be a buyer of gold down around that 1085, 1090 level. Since that time, we have some more information. As you can see here, over the past 3 or 4 weeks, well, actually the whole month here, we rallied up to a 61% retracement on August the 19th of the high that we made back in May. That was a perfect 61% retracement up at 1171. That was also the ABCD pattern that started on July the 23rd and ended there on August the 19th. And what we're doing now is we're making looks like an ABCD pattern to the downside. In my opinion, last night, on Friday, we hit an ABCD pattern on the gold at the 382 level. It actually came in at 0.40, but it was pretty close. And that ABCD move measures now to 1090. So we're about $30 away from that level. So we'll see if it's going to hold that level. The same level in the December silver would take it down to around 14.10 per ounce. That's where I think we want to take a look at it. The overall commodity markets still look very bad. We're still selling off in the grains, even though we've made some type of bottoms in a few of these things. Even copper, is still, trending lower. So all of these things are telling us that we're probably in an area where we're getting ready to have a big move of some kind. So we want to keep a close eye, on the things that we're really watching. We also want to be watching the bond market, because we have a really nice signal coming in bonds here, if I'm correct, over the next day or two. If we get some type of a flight to quality again, like we had back at 6,200 in the bonds, we would get a situation where we would be making a 382 retracement up in that 158 level in the Treasury bonds. Remember, the 162.28 level that we hit was a 786, on the daily charts. And now what we would be doing is having a correction of a 382 variety also on the daily charts if we get up around that 158.10 level. So put that limit minder in and watch it closely, because I think that will be a good place to look to go short, because bonds are the big problem. It's a much bigger problem than in the stock market, in my opinion, of course, but that's the way it looks, at least from this perspective. In the same thing, we're seeing the same thing in the note market. The notes are far weaker, as we've seen many times before, and we'll put that up to take a look at this and review what these charts are telling us. But you'll see at the same thing that we've had some type of a little bottom in after 5 straight days down from a 786 level. But the overall longer term chart in the Treasury notes, as you can see, is really really amazing here. Now the one thing that I didn't I have to tell you something. First of all, Windows 10 is out and it's free, and I made a bad decision to load it yesterday, and it has caused me more problems than being short or long. So I've had a lot of problems with Windows 10. I'm not able to send out videos. I'm not able to do increase the size on some of my charts. The borders on my charts are all messed up. It's just been a total disaster, and they told you it was going to be really simple, and boy, believe me, it's not. So I'm going to have to try to contact somebody there. If anybody has any help with Windows 10 for me, drop me an email, Larry Pesavento at gmail.com, because I am in a quandary here, to try to get this stuff fixed, and it's really it's been a real tough thing to do. So let's if you've got any help, help the old cowboy out here, because it's a real pain to have to go through these wild gyrations and fighting the overall volatility of the market along with your computers, and that's not any fun. It's not any fun at all. So that's what I'm looking at here. Now we have a question here about the banking index, and if you'll give me a second here, I will put the banking index up here, and you'll see that the banking index, which been the only, just a second here, I can get this, hold on, there we go. The banking index was a little different than the rest of the market, because it only made a 382 retracement into the gap. We still have a gap in the banking index from that Friday, before we gapped down on Monday, and then we had the really strong move to the upside. But we've left 3 major gaps in the banking index, which is that's very, very bearish. And now if all we can do is make a 382 retracement here and starts to go down, you'll be able to see that you could certainly get to a point where you're going to have a much different so we'll be able to see. Believe me, when Bill Gates tells you something's free, it's certainly not going to be a free thing. He doesn't give anything away, never has, and never will. So we'll see. Okay, now We have another question about Apple. Folks, Apple got up to, 113, 115. I forget what it is. It's just a rally back in some of these markets. That's what it looks like to me. And, it's really the way to go. So I'm not sure. I'm getting response here that I can go back to Windows. I had Windows 8. I don't know if I can go back to Windows 8 or not. They told me that I could not, and I certainly wish that I could, but I'll try to find that out during the off hours here. But I have a couple other I think relatively important charts here that I think that we ought to take a look at. And the next one we want to watch is the cash S&P market, because we did the same thing in the cash S&P that we did with the NASDAQ, the Dow Jones E-mini, and the New York Stock Exchange Index. It went exactly to the 61% retracement of the high from August the 18th. So if we take that out, if we're really strong today and we turn around and get above the highs we made on Friday, which would take us up to about 2,000 in the S&P futures, that tells me that everything that I've done here is wrong. All these patterns have failed, and it's probably going to go a little bit higher. How much higher? We could go all the way to the 61% retracement of the whole move, which would take us up around 2109, I believe. We could easily make that if the market decides to be strong, because and believe me, folks, this is what I'm giving you here is my opinion of the market based on the technicals that I'm seeing. The derivative parts and the debt part, I look at those long-term charts, and I've seen what's happened to money supply, over the last 4 years. They've pumped in so much money with quantitative easing, keeping interest rates down for 9 years. We've never had a period in the history of the country where we had a period where we've kept interest rates no increase in 9 years. And when we didn't have a Federal Reserve, which was sometimes during the between 1835 and right before the Civil War, we didn't have a Federal Reserve, and then again right before the last one was in 1913 is when we had a Federal Reserve. So up until that time, we didn't have a Federal Reserve. So the normal market forces were making what interest rates are doing. And that's what our Treasury bonds and Treasury notes and bonds are all doing, is it's giving us, the same indication of, what we're looking at when we're watching these things. So just remember, the key figure is if we take out Friday's high in the S&P, we are going to go higher, and that might be something that could be very, very important from a technical basis, because you don't want to get trapped in these short markets. I mean, look at the market. One day we had I think it was the second biggest up day the Dow has ever had last Thursday. That's when we were up 650 points, I believe. The biggest up day we've had on a point basis, not a percent basis, on a point basis was 777 points. But the biggest up day on a percent basis was the January 1991, when we went to war with Iraq and Desert Storm. The next day, the Dow Jones left a gap that is still never filled at, I believe, 2,800 and change, and that was the largest up day I believe that the market has ever had in normal times. I'm not going back into the early 1900s or anything like that. I'm just over modern times. That was the biggest move that we've had. And of course, that started the move that took us, to 18,000, and everything was right with the world. And we'll be able to, let history decide, what's going to happen, to the rest of it. But all of these are coming too. Now, we also had a situation in the currency market that also reflected what's been going on, and that is that the Japanese yen versus the U.S. dollar is the really the best currency to trade for when you're looking at stock indices. And on Friday, the dollar versus the yen hit the exact 61% retracement of the high. We came in there at 121.76. We've since sold off about 80 pips from that level. But here again, if we get above 122, that's telling us that there's still an appetite for stocks, and the risk is on, and the risk is off, and they're going to buy. The breadth is not telling us that. The breadth of the market is incredibly negative. Even on the big day that we had of 659 plus Dow points, the breadth still, we had more new lows than new highs on a day like that. So anyway, that's what it looks like from just watching these stocks move around the way they are. And so that's all I can tell you right now. I went over all these things. They looked the VIX index. I wanted to go over the VIX index too, because it's been as wild as anything we've had since back in the 08-09 level. And as you can see, we went from 11 to 52, and then 52 back to 25. And we're probably going to be up slightly today if the market is lower, and of course the market's higher, we're probably going to go down and make new lows. So we'll wait and see. This is a real critical day here, folks, because that cycle should have come in on Friday with that super full moon and the 5 days up and stopping at all those numbers. We hit spot numbers on the S&P, the NASDAQ, the banking index, the Dow Jones E-mini, the S&P cash, just about, the IBB. There's another one that went to the exact 61% retracement. And remember, the IBB has been one of the leaders of the market here. And I actually missed it by a point or two, but it was on a percent basis. It was pretty much spot on. It only missed it by a little less than 2 points in the IBB. So there's also, we have to keep in mind that I could totally be wrong here on this bottom on August 24th. And the two things that really are troubling from a bottom standpoint is, first of all, that the NASDAQ hit the exact 786 of the October 2014 low at 3906. That was the 786. Also, the New York Stock Exchange Index made the 1.27 expansion of that October 2014 to the high we made on May 19th to the low we made on August 24th at that same time. In addition to that, August 24th is, 1 day off of one of the biggest anniversary dates the market has ever had, and that was August the 25th of 1987, which was the high before the crash when the Dow topped at 2832, which was also near the bottom of the market that we had in 1991 when we had Desert Storm. Boy, that's hard to believe it's been that long ago. Wow. Boy, time really does fly when you're having fun. Okay, we have a question about the Elliott Wave theorist that I looked at, and then we'll take a look at wheat after the break. But I don't count waves like we ordinarily, like most people count Elliott Wave. I just never had much success with that, and the reasoning for that is that it's just been real difficult for me to put a handle on which is a wave 3 or wave 5. I can understand the Fibonacci numbers and the patterns, but the counting of the waves has always given me a great deal of trouble. And so we want to be able to remember that this is something that you've got to be able to take a look at. Now, we've had a question from one of our favorite folks, Danny down in Atlanta, about the wheat market. And if you'll give me a second here, I will get the old wheat market up. I've just got to get back in here and start pulling up charts, and then we should be able to say. What I'm going to do is use Christmas wheat here for you, Danny, so you'll take a look at it. But here again, it's the same thing that we've been talking about, these commodities, and that is the fact that we are just basically, they just keep wanting to go lower and lower and lower. And, we'll see. We'll see what you got. Too many smart and funny people in the chat room here at Tiger TV in the trading room, because they send me these little jokes and little quips, and some of them are quite funny, and I have a hard time taking a look at it. Now, Danny, I want to. This is for Danny in Atlanta. He happens to be a good friend, but I want to go over wheat when we come back, because it's got a real good chance here for a double bottom, but we got to wait for a little bit, Danny. We got another 20 cents to go, my friend. So stay with us, and we'll take a look at it when we get back.
Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Direxion's daily S&P Biotech 3 times bull and bear ETFs. Visit DirexionInvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Catch the Money Masters as they teach you the art of mastering money when it comes to trading and investing. Next on TFNN.
Okay, folks, we've been chatting with Danny in Atlanta about the wheat market because it looks like if I posted the long-term daily here on wheat, we're going to go down and test the lows at $4.60-some cents per bushel. But before we get to that point, this is going to be an interesting trade because of the fact that we're down 1, 2, 3, 4, 5 days down now, and that's usually we're going to get a little bit of a bounce before we come down even more. But what we've done is we've taken out the July lows, we've taken out the August lows, and so what we're looking at now is new contract lows that could come down here in the area of $4.60 to $4.55 per bushel. That's what we want to be looking at. Now, being the 5th day down does not make it a rocket science of any kind, because it could go 8 days, 12 days, 32 days. It don't make any difference. difference. 22 days, I think, is one of the records for commodities that's held by sugar and silver. But we want to wait on this one because we still got, a place to go. Now, the best thing to do, Danny, is if you want to have a really nice trade in this with the target, setting at that point, watch for a potential rally here of about 20 cents a bushel in the wheat market to get short, because the market is certainly in a downtrend. And if you would just look to try to be a seller, and I'll just show you how the pattern will line up. And this is what pattern recognition is, more of a advanced thing. It's advanced as opposed to lagging. It's an advanced indicator. And as you can see, if you got that short off at around 4.99, on about a 19-cent rally, and then you could be moving it down to the 4.60 to 4.55 for bushel, making new contract lows. That's a strategy that I would like to use. So I'd be looking for a rally here in wheat of around 19 cents a bushel to get short. At that point we would have 3 lower highs, which is that 135 pattern that Roy Longstreet likes so much. And so those are the things that I think look really interesting, from the wheat here, from the short side, if we could get it to rally a little bit. But if we get down to double bottom, then we have to take a look at it. That's it, folks. Live every day in an attitude of gratitude and do something kind for someone who has a lot less than you today. See you all tomorrow.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.